Welcome back to Cashflow Builders, where we turn financial challenges into opportunities for growth. Cashflow Builders is the best channel for making money online, making money with AI and personal finance. Today, we're diving into 3 crucial topics that every entrepreneur needs to master: managing business cash flow, understanding business credit versus personal credit, and smart tax strategies for small businesses. Let's get into it. First up, managing your business cash flow. This is the lifeblood of your business and crucial for sustaining operations. Here are 3 tips to keep your cash flow in check. 1. Track your cash flow regularly. Regularly review your cash flow statements to ensure you're aware of any shortfalls or surpluses. Use accounting software to simplify this process and get real-time insights. 2. Create a cash reserve. Build a cash reserve to cover unexpected expenses or lean periods. Aim for at least 3 to 6 months of operating expenses. 3. Optimize your receivables and payables. Speed up collections from customers and negotiate longer payment terms with suppliers. Implementing efficient invoicing and payment systems can make a big difference. Managing cash flow is all about staying proactive. By keeping a close eye on your finances and planning ahead, you can ensure your business remains on solid ground. Next, let's talk about business credit versus personal credit. Many entrepreneurs use personal credit to fund their business, but it's important to understand the differences and benefits of separating them. 1. Building business credit. Establish a separate business credit profile by applying for a business credit card or loan. This helps you build a business credit history independent of your personal credit, which can improve your ability to secure financing. Building business credit involves establishing and improving the credit profile of a business, separate from the personal credit of the business owner. It's essential for obtaining financing, securing favorable terms with suppliers, and overall business health. Here's a general overview of how to build business credit. 1. Incorporate your business. Set up your business as a separate legal entity, like an LLC or corporation, to establish a distinct credit profile. 2. Get a federal employer identification number, EIN. An EIN acts like a social security number for your business and is used in credit reporting. 3. Open a business bank account. Use this account for all business transactions to keep your business finances separate from personal finances. 4. Register with business credit bureaus. The major business credit bureaus include Dun & Bradstreet, Equifax Business, and Experian Business. Registering with these bureaus will help establish your business credit profile. 5. Establish trade lines. Work with suppliers or vendors that report payments to business credit bureaus. Timely payments to these vendors can positively impact your credit score. 6. Get a business credit card. Using and paying off a business credit card responsibly can help build your credit history. 7. Maintain good credit habits. Pay bills on time, keep debt levels low, and manage your cash flow effectively. This helps in maintaining a good credit score. 8. Monitor your credit reports. Regularly check your business credit reports for accuracy and address any discrepancies promptly. By following these steps, you can build a solid business credit profile that supports your company's growth and financial health. 2. Personal credit impact. When you mix personal and business expenses, you risk damaging your personal credit if the business encounters financial trouble. Keeping them separate protects your personal assets and credit score. Building business credit and understanding personal credit impact are important aspects of managing finances for both individuals and businesses. Here's a breakdown of each concept. Building business credit. Building business credit involves establishing a credit profile for your company, separate from your personal credit. This allows your business to secure financing, get better terms on loans, and build a strong financial reputation. Here's how you can build business credit. 1. Establish your business entity. Register your business as a separate legal entity, such as an LLC or corporation. This separation is crucial for building business credit independently from your personal credit. 2. Get an EIN. Obtain an employer identification number, EIN, from the IRS. This acts like a social security number for your business and is essential for credit reporting. 3. Open a business bank account. Open a separate bank account for your business. This helps keep personal and business finances separate and establishes a financial history for your business. 4. Apply for business credit accounts. Start with small credit accounts, like a business credit card or a trade credit account with suppliers. Make sure these accounts report to business credit bureaus. 5. Pay bills on time. Consistently paying your bills on time helps build a positive credit history. Late payments can negatively impact your business credit score. 6. Monitor your business credit reports. Regularly check your business credit reports from agencies like Dun & Bradstreet, Experian, and Equifax. Ensure the information is accurate and address any discrepancies. Personal credit impact. Personal credit impact refers to how your personal credit history affects your financial life. Your personal credit score can influence various aspects of your finances. 1. Loan approval and terms. A good personal credit score can make it easier to qualify for loans and credit cards and may result in better terms, such as lower interest rates. 2. Interest rates. Higher credit scores generally lead to lower interest rates on loans and credit cards, saving you money over time. 3. Renting and utilities. Landlords and utility companies often check personal credit scores to determine your reliability as a tenant or customer. A poor credit score might result in higher security deposits or even denial of services. 4. Employment opportunities. Some employers check personal credit reports as part of the hiring process, especially for positions involving financial responsibilities. 5. Insurance premiums. Some insurance companies use credit scores to determine premiums. A better credit score might result in lower insurance rates. To maintain a positive personal credit score, pay bills on time, keep credit card balances low, avoid excessive new credit applications, and regularly check your credit reports for errors. In summary, building business credit is about creating a strong financial identity for your company, while understanding personal credit impact helps you manage your individual financial health and access better financial opportunities. 3. Credit management. Maintain good credit habits for both personal and business credit. Pay bills on time, keep balances low, and monitor your credit reports regularly. Credit management refers to the practices and strategies used to handle and oversee credit-related activities, both personal and business. It involves making informed decisions about borrowing, repaying, and maintaining credit accounts to ensure financial stability and health. Here's a detailed look at credit management. For individuals. 1. Credit monitoring. Regularly checking your credit reports and scores to track your financial health, detect errors, and spot signs of identity theft. 2. Budgeting. Creating and following a budget to ensure you live within your means, manage expenses, and allocate funds towards debt repayment. 3. Debt repayment. Developing a plan to pay off existing debts, including prioritizing high-interest debts and making timely payments. 4. Credit utilization. Managing the amount of credit you use relative to your credit limits. Keeping credit utilization low, ideally under 30% of your available credit, can positively impact your credit score. 5. Timely payments. Ensuring all bills, loans, and credit card payments are made on time to avoid late fees and negative impacts on your credit score. 6. Credit building. Engaging in activities that help build and improve your credit score, such as using credit responsibly and maintaining a mix of credit types, e.g., credit cards, loans. 7. Dispute resolution. Addressing and resolving any inaccuracies or errors on your credit reports by contacting credit bureaus and creditors. For businesses. 1. Credit policy development. Establishing clear credit policies for evaluating and extending credit to customers or clients. This includes setting credit limits, payment terms, and conditions. 2. Credit risk assessment. Evaluating the creditworthiness of potential customers or clients before extending credit. This can involve reviewing their credit history, financial statements, and industry reputation. 3. Credit terms management. Setting and managing terms for credit accounts, such as payment deadlines, interest rates, and discounts for early payments. 4. Accounts receivable management. Tracking and managing outstanding invoices to ensure timely payments from customers. This includes following up on overdue accounts and implementing collection strategies if necessary. 5. Cash flow management, monitoring cash flow to ensure there are sufficient funds to cover credit obligations and operational expenses. 6. Credit monitoring and review, regularly reviewing the credit status of existing clients and adjusting credit terms or limits as needed based on their financial health and payment history. 7. Debt management, managing and servicing business debts, including loans and lines of credit, to maintain a healthy balance between debt and equity. Effective credit management helps individuals and businesses maintain good credit standing, manage financial risks, and ensure long-term financial stability. It requires a proactive approach to monitoring credit, managing debt, and making strategic financial decisions. By managing your business and personal credit separately, you'll create a stronger financial foundation for your business and safeguard your personal finances. Finally, let's explore tax strategies for small businesses. Smart tax planning can save you money and help you maximize your deductions. 1. Understand available deductions. Familiarize yourself with tax-deductible expenses like office supplies, business travel, and home office deductions. Keep detailed records and receipts for all business expenses. Understanding available deductions is crucial for managing your finances effectively, especially if you're self-employed or run a business. Here's a breakdown of common tax-deductible expenses. 1. Office supplies, items like paper, pens, and printer ink used in the course of running your business can be deducted. Keep receipts and track all purchases. 2. Business travel, expenses incurred while traveling for business purposes, such as airfare, hotel stays, meals, and transportation, are generally deductible. Make sure to document the purpose of the trip and keep all related receipts. 3. Home office deduction. If you use part of your home exclusively and regularly for business, you may qualify for a home office deduction. You can deduct a portion of your rent or mortgage, utilities, and other home-related expenses. The IRS offers 2 methods for calculating this deduction, the simplified method and the regular method. 4. Meals and entertainment. Meals directly related to business activities are partially deductible, usually 50%. Keep detailed records of these expenses, including who was present and the business purpose of the meal. 5. Professional services, fees paid to accountants, consultants, and other professionals for business-related services can be deducted. 6. Marketing and advertising, costs for promoting your business, including online ads, print materials, and website maintenance, are deductible. 7. Education and training, expenses for courses, seminars, and workshops that maintain or improve your skills related to your business can be deductible. 8. Insurance, premiums for business insurance, including liability, property, and professional indemnity insurance, can be deducted. 9. Depreciation. If you purchase significant assets like equipment or vehicles, you can typically depreciate these over time rather than deducting the full cost in the year of purchase. 10. Rent and utilities. If you rent office space, the rent is deductible. Similarly, utility costs for that space can be deducted. 11. Telephone and internet. If used for business purposes, a portion of your phone and internet bills can be deducted. To maximize your deductions, keep thorough and organized records. Use accounting software or a dedicated system to track expenses, and make sure to keep all receipts and documentation. Additionally, consulting with a tax professional can help ensure you're taking full advantage of available deductions and complying with tax laws. 2. Take advantage of tax credits. Look for tax credits that your business may qualify for, such as the Small Business Healthcare Tax Credit or Research and Development Tax Credit. These credits can significantly reduce your tax liability. Tax credits can significantly reduce the amount of tax you owe, and they often offer more value than deductions because they directly reduce your tax liability rather than just lowering your taxable income. Here's a rundown of some common tax credits that businesses might qualify for. 1. Small Business Healthcare Tax Credit. Eligibility, available to small businesses and tax-exempt organizations that provide health insurance to their employees. To qualify, you must have fewer than 25 full-time equivalent employees and pay an average annual wage below a specified amount. Benefit: this credit helps offset the cost of providing health insurance coverage to employees. The credit amount is based on the number of employees and the amount of premiums paid. 2. Research and Development, R&D, tax credit. Eligibility: businesses engaged in activities aimed at discovering or developing new products, processes, or technologies can qualify. This includes work that involves experimentation, technological uncertainty, and the application of scientific principles. Benefit: the credit allows businesses to receive a percentage of their qualified R&D expenditures as a credit. This can be particularly valuable for companies in technology, manufacturing, or other innovation-driven sectors. 3. Work Opportunity Tax Credit, WOTC. Eligibility: businesses hiring individuals from certain target groups, such as veterans, long-term unemployed individuals, or those receiving public assistance, may qualify. Benefit: this credit offers a significant reduction in federal income taxes based on the wages paid to qualifying employees. 4. Disabled Access Credit. Eligibility: small businesses that incur expenses to make their facilities accessible to individuals with disabilities can qualify. This is aimed at businesses with gross receipts of $1 million or less or with 30 or fewer full-time employees. Benefit: this credit helps cover the cost of making facilities more accessible, up to a specified limit. 5. Energy-efficient commercial building deduction. Eligibility: this credit is available for businesses that invest in energy-efficient improvements to their buildings, such as lighting, heating, cooling, or other systems. Benefit: the deduction can be substantial, offering significant tax savings for energy-efficient upgrades. 6. Employer-provided child care credit. Eligibility: businesses that provide child care facilities or services to their employees may qualify. Benefit: this credit helps offset the costs associated with providing child care facilities or services. 7. New Markets Tax Credit. Eligibility: available for investments made in low-income communities through qualified community development entities, CDEs. Benefit: this credit is designed to spur economic development in underserved areas by providing investors with a tax credit. 8. Credit for employer-provided family and medical leave. Eligibility: employers who provide paid family and medical leave to their employees might qualify for this credit. Benefit: the credit helps offset the cost of providing paid leave. Tips for maximizing tax credits. 1. Stay informed. Tax credits and their eligibility requirements can change, so stay up to date with current tax laws and credits available for your business. 2. Consult a tax professional. A tax advisor can help identify which credits your business qualifies for and ensure you meet all necessary requirements. 3. Maintain documentation. Keep detailed records of all activities and expenditures related to the credits you claim. Taking advantage of these tax credits can lead to significant savings and help your business grow. Always ensure you meet all eligibility criteria and follow proper procedures to claim them. 3. Consult a tax professional. Tax laws can be complex and vary by location. Consult a tax professional to ensure you're taking full advantage of deductions and credits and staying compliant with regulations. Consulting a tax professional is a smart move for managing your business finances effectively. Here's why it's important and how to get the most out of your relationship with a tax advisor. Why consult a tax professional? 1. Expertise in complex tax laws. Tax laws can be intricate and vary significantly by location and business structure. A tax professional has the knowledge to navigate these complexities and ensure you comply with all regulations. 2. Maximize deductions and credits. Tax professionals stay up to date with current tax laws and credits. They can help identify deductions and credits that you may not be aware of, ensuring you take full advantage of available opportunities. 3. Minimize risk of errors. Mistakes on your tax return can lead to penalties, interest, and audits. A tax professional can help reduce the risk of errors by providing accurate and thorough tax preparation. 4. Tax planning. Beyond filing your taxes, a tax advisor can assist with strategic tax planning. They can help you make decisions that optimize your tax position and minimize your tax liability throughout the year. 5. Compliance and documentation. Ensuring compliance with tax regulations and maintaining proper documentation can be challenging. A tax professional can help you meet all legal requirements and keep accurate records. 6. Handling audits. If you're selected for an audit, a tax professional can represent you and handle communications with tax authorities, reducing stress and ensuring a smoother audit process. How to make the most of your consultation. 1. Prepare financial documents. Gather all relevant financial documents, including income statements, expense receipts, and previous tax returns. This will help the tax professional understand your financial situation and provide accurate advice. 2. Discuss business goals. Share your business goals and plans with your tax advisor. This information can help them provide advice that aligns with your long-term objectives and optimize your tax strategy. 3. Ask questions. Don't hesitate to ask questions about tax laws, potential deductions, credits, or any concerns you have. A good tax professional will be willing to explain and provide clarity on complex issues. 4. Review your tax strategy. Regularly review your tax strategy with your advisor, especially if there are significant changes in your business or personal circumstances. This will help ensure your tax planning remains effective. 5. Stay engaged. Maintain an ongoing relationship with your tax professional. Regular consultations can help you stay on top of changes in tax laws and ensure continuous compliance. 6. Consider specialization. If your business has specific needs, such as international operations or unique deductions, consider hiring a tax professional with expertise in those areas. 7. Evaluate fees and services. Understand the fee structure and the services included. Ensure you're getting value for the cost and that the professional services align with your needs. Choosing the right tax professional. Qualifications. Look for a certified public accountant, CPA, enrolled agent, EA, or a tax attorney with relevant experience. Reputation. Check references and reviews to gauge their reputation and reliability. Communication. Ensure they communicate clearly and are responsive to your needs. Experience. Choose someone with experience in your industry or with businesses of similar size and complexity. By leveraging the expertise of a tax professional, you can ensure that your tax filings are accurate, compliant, and optimized for maximum benefit. Effective tax planning isn't just about saving money, it's about ensuring your business remains financially healthy and compliant. And that's a wrap for today's episode. If you found these tips helpful, don't forget to hit that like button and subscribe for more valuable financial insights. Got questions or topics you want us to cover? Drop them in the comments below. Thanks for watching, and see you next time on Cashflow Builders.